Thank you very much. Money, yes, it is topical. There's a very interesting presentation, if you like, by John Pierpont Morgan back in 1912 to Congress. And I don't know what the question was, but his answer was quite simple, and that is money is gold and the rest is credit. Now you might think that that was just an opinion of J.P. Morgan, but actually it is a legal fact. And it's forgotten nowadays. I mean, so much so that modern economists think that gold is a pet rock, or it's no longer relevant, if you like, to the modern monetary system, but it still remains to be money. So that's really what the talk here is about. Now, you've got money, currency, and credit. And I'll start off with money. Money is gold and silver coin or bullion. In this country, from 1817 onwards, the sovereign was exchangeable, this is until the First World War, of course, was fully exchangeable for every pound that was issued. Whether that pound was a pound note from the Bank of England, or indeed a deposit in a commercial bank, that you could exchange for gold coin in the form of sovereigns. £1, one sovereign. And the start of this goes all the way back to Roman times. Justinian codified earlier findings of Roman jurors as to money, credit, and whether credit was something that, whether it was a mutuum, in other words, it was something which, you could deposit in the bank and it was yours, or whether it was a depositum, in other words, you entered into a relationship with the banker whereby he owed you money. And that is, if you like, the way modern bank credit works. So it goes all the way back to the time of Justinian. Now, by the time Justinian codified this, of course, the Romans had left this country. So it wasn't really properly tied up in common law, but that was corrected when common law merged with the Court of Chancery in 1875. And from then on, it was formalized that money was gold. The roll of silver was small change for anything less than £2. That was the original relationship. So anyway, that is money. Nothing else is money. It's as simple as that. Now, currency is a circulating medium which is used for the buying and selling of goods and services. And it comes in two forms. You've got banknotes, which we all are all familiar with. And banknotes are basically, if you like, a debt on the Bank of England. It owes you £1. And I don't know if you've looked at the new notes, but you find that I promise to pay the bearer. The writing has got incredibly small. It gets smaller and smaller with every issue. But that is why it's I promise to pay the bearer. I promise to pay the bearer in sovereigns, in gold, money. That's the key thing. The vast majority of circulating medium is bank deposits. And that's credit owed by a bank to its depositors. And nowadays in this country, I reckon, is somewhere like 95 to 97% of the circulating medium. So when you look at circulating medium, it is essentially more or less only bank deposits. Now, the other side of that are bank loans, which are created by a bank in favour of the borrower. Not many people actually understand the basis on which bank credit is expanded, but it's very, very simple. You've got to bear in mind that banks run a double entry bookkeeping system, which is simple. We all do, or we should do. If you go into the bank and you want to borrow some money, and you manage to persuade the bank to lend you the money, you will sign the documents. And then as you go out of the door, the bank manager will say, well, thank you very much indeed. We've agreed the loan. The money is now in your account. Now, what he means by that is that he has created an entry on the asset side of his balance sheet, and there has to be a contra entry on the liabilities side. The asset is the loan to you. On the deposit side is your money. They must balance out. Nobody else has been involved other than the bank itself. It has created this out of thin air. And so a bank, they're dealers in credit, and they create loans and deposits for interest profit. It's important to remember that. They do not have a role in society as a social something or other. Regulators seem to forget that they are actually dealers in credit. But at the end of the day, that is the thing that drives the cycle of bank credit expansion and contraction. And it's very important to understand that, because we've had these cycles ever since banking was invented. Why? Because you get a cohort of bankers who all think the same way. When they see the economy is picking up, generally as a result of an earlier expansion of bank credit, it gives them confidence to increase their lending. And by creating this credit out of thin air, what they do is they increase the leverage on their balance sheet relative to the bank's own capital. They don't lend their own capital. No, they just create credit on top of it. That process continues until the consequences of the expansion of bank credit are that prices start rising. We call it inflation, but in fact it's rising consumer prices, reflecting a fall in the purchasing power of the currency. When you get that expansion, if you like, the business calculations of the borrowers who, have always been industry, though we've got consumers now, we'll put that to one side. Industrial calculations start going awry because they made assumptions which are no longer true. And when that happens, the bankers see this. So they start restricting the amount of credit that they lend, because they will have an eye, not on what the regulator tells them, not on what Basel III tells them about maintaining liquidity on the balance sheet, but what they will look at, quite simply, is the relationship between the total assets on their balance sheet and the equity, the bank's own equity, or in modern terms, we're talking about shareholders' equity on the balance sheet. And that has expanded, and I'll get into that in a bit more detail further on. But you can see the effect of the expansion over time. This is broad money supply for the United States. It has increased roughly 33 times from the 1960s to the present day. And interestingly, you can see that the growth is starting to top out. So we've got, if you look at the breakdown of that M3, you've got US banknotes 2.28 trillion. Now of that, it's estimated that as much of half of it is actually circulating outside the United States. The bank credit outstanding is 17.3 trillion, and the ratio of bank credit to banknotes is 7.6. But if you take into account the dollars that are circulating, the paper dollars that are circulating outside the United States, you can see that it's probably closer to 15 times. And the point about money, gold, is that it does not figure in today's currency system. Now the reason for that, quite simply, is Gresham's law. Why do you hold gold coin? It is the last thing. You will, if you like, sell pounds or transfer money from your bank account into a coin dealer's account to gain gold. And you do that basically because you are worried, let's say, about the stability of the currency. Now, what you end up doing is just hoarding it. And at times when when the general public are more worried, they will hoard more of it. When not so, less so. And interestingly, countries which have tended to be on a gold standard have found that their citizens don't really need to hold gold because they've got confidence in the currency. And that's the situation which actually we don't see too much today. Now, so what happens to the currencies? The purchasing power of currencies has basically collapsed since the Bretton Woods Agreement was ended on August 1971. And you can see here the British pound, the price of oil in the British pound. I mean, look at the volatility of it. It is shot up, I mean, nearly 80 times, and it's still rising, I think. US dollar slightly less so. But the interesting one is the red line along the bottom. That is pricing oil in gold grams. In 1950, in dollars, the price of oil was about $2.50 a barrel. I think it was about $2.65 a barrel. Today, in gold grams, the price is something like 20 to 30% less than it was in 1950. Yet look at the volatility in these paper currencies. I mean, the idea of a currency is that you should have some confidence in the purchasing power of that currency, because you use it as the if you like, as the medium between translating your earnings, you know, your labour, into the products that you want. It is the way the division of labour works. Money is that thing in the middle, and really what you expect out of money is that you can use that, if you like, confident that all the change in the price, or if we're negotiating, say, the purchase of something of a bazaar stall, all the change in the price is in the goods being bought. It's all subjective on that side. So, I mean, you know, a currency should be objective in transactions, but you can see that actually this is not the case. Now, I was mentioning bank credit cycles earlier. This is basically the period of the gold standard. It actually started in 1817. But if you look at the 90 years up until, that's about 100 years actually, to the start of World War I, when the gold standard was suspended, you can see that there were substantial fluctuations, particularly in the early days, in the rate of changes in wholesale prices. And that was basically what that is the result, as the consequence of, is increases in the quantity of bank credit. You get this cycle where, as I said earlier, bankers are optimistic when things start getting better. They expand their loans, they expand their balance sheet, and then when things start reflecting that extra injection of currency into the system, then, or credit into the system, then what do? They suddenly slam on the brakes. And of course, bankers being bankers, they all think the same way. They talk to each other. The businesses to which they lend money or lend currency or credit, you know, they all start having the same problem from prices at the same time. Their business calculations start going wrong. So while you might get a reasonable period of expansion, it suddenly comes to a halt. And it's fairly regular. I mean, that cycle is roughly 10 years. You know, 10 years from peak to peak to peak to peak. After about, I think it was 1868, it calmed down a lot, and the reason for that was technical. The Bank of England in 1868 joined the commercial bank settlement system, which smoothed out, it had the effect of smoothing out transfers between banks and therefore the disruption, if you like, to the whole system. But the other thing that's interesting is if you look at if you look at the wholesale borrowing cost, it was actually pretty level the whole way through. Prices followed that with, you know, a little bit of a differential. But the point was that from 1814 to the First World War, there wasn't actually much change in prices. Why? Because you could change your bank credit for sovereigns. And as long as people knew that, they were happy to hold on to pound notes, deposits in the bank, or whatever. There were a few crises, obviously, which disrupted that. But the important point about that is that this is something that defies the monetarist approach. What the monetarists do not understand, or have no room in their argument for, is the changing preference of people for money. What I mean by that is that if they look at the sovereign and they know that there's gold and it is properly backing bank credit and they can exchange it for bank credit, there's no need for them to do so. And if you get a situation where the purchasing power might tend to fall slightly, then all they do is they withhold their spending, because a fall in the purchasing power means rising prices. So what they would do is they will increase their preference for holding on to credit, because it is properly linked to gold. Now that's something we don't have today, which I will come on to shortly. So what's happened since, 1971, August 1971 was when Nixon came off the gold standard. If you go back to the beginning of 1970, really we had the exchange rate for the dollar to gold was $35 for 1 ounce of gold, and all other currencies were effectively linked to to gold through the dollar. We poor peons weren't able to exchange dollars or our currencies for gold, but central banks and outfits like the IMF were. What drove the end of the Bretton Woods agreement was that particularly the French and a few others decided that they didn't want any dollars. They had too many dollars. I mean, bearing in mind, we're talking about the end of the, or round about, it's probably around about the beginning of the Vietnam War. France's Far Eastern interests were in Indochina, which basically was Vietnam. The Americans didn't pay for their wars by taxing their people. I mean, no government succeeds in doing that. They did it basically by printing dollars for export. And that's what they continue to do with the Iraqi war and all the rest of it. And we hear stories about how plane loads of $1, $5, $10, and $100 bills are basically shipped to places like Baghdad to keep, if you like, the war going. And that basically what happened. Those dollars started coming back through French hands, through they accumulated in the hands of the Banque de France, and the Banque de France had too many dollars, so they started redeeming it for gold. At the same time, we saw that in post-war years, the Germans, in their recovery, they had export surpluses, and that meant that they had accumulating dollars. They changed a lot of that into gold. That was the basis of their post-war wealth, if you like. But what happened after that was basically currencies collapsed. That's what that shows. And if you look at sterling, which is the bottom one there, it's actually lost, from that $35, it's lost 99% of its purchasing power. Do we notice it? No, we don't. But that is actually what has happened. It's very important to understand the difference between currencies and money. Now, we've sort of come to an interesting point, because the Bretton Woods Agreement ran from 1944 to 1971, which was a sort of very tenuous link with gold. But it did give price stability, as you saw in one of the earlier charts. From 1973 to 2021, Kissinger and Nixon struck a deal with the Saudis. They said, and basically the deal was that the Saudis had control of OPEC. And the deal was, you can price oil anything you like. We can't stop you doing that. But the one thing we insist is that you receive your currency in return for oil, always in dollars, which means it always goes into an American money center bank. And what that permitted was it permitted the American financial system to recycle those petrodollars to other nations which were suffering at that time, particularly in Latin America. Now, this was really driven by, if you like, a political imperative. They wanted to keep Latin America on side. This was the time of Che Guevara and all the rest of it. So you can see that that was a very pragmatic deal. What happened, really, and particularly from about 1984-5 onwards, was the abandonment of Bretton Woods really meant that the dollar had to find some other way of having demand created so that its purchasing power would be maintained. And apart from the problem they had through the 70s, when you got over that and Volcker jacked up the prime rate to 20%, which basically was telling everybody, you want to sell dollars? Look what you're going to miss out on, a 20% interest rate. And it was enough to stabilize the dollar. But after that, they needed something else. And this was the increased financialization of the global economy. We had Big Bang in London, for example. The whole of the derivative industry, OTC derivatives, really started from that point, Why? Because what they were doing is they were using the derivatives to suppress the prices of things that you might buy in dollars, commodities, gold, energy. And the reason for doing that was quite simple, and that was to create demand for dollars. Now that period led to declining interest rates because, of course, everybody had to accumulate dollars, and that period actually ended literally last year with zero interest rates. That was introduced in March 2020, in the beginning of the COVID situation. The ECB went negative sometime before that, and the Bank of Japan also went negative. And Bank of Japan is still negative. So you can see that that was a long-term trend from Volcker's 20% prime rate all the way down to zero. Now it started going up again, and it's going up for a number of reasons. A principal one is that the expansion of the quantity of currency and credit in the wake of COVID meant that if you like, the price effect was beginning to work through. The purchasing power of all our currencies started declining as a result of that. Overwhelming, if you like, this sort of peace, if I can call it that, where there was continual demand for dollars, and therefore there was nothing to really worry about. That has suddenly changed. And then we made things worse because we decided to try and stop President Putin from invading Ukraine. And as part of that, we introduced sanctions. So what happens is that we drive up the price of energy, we drive up the price of everything else, on top of supply chain problems, which is paid for by the expansion of credit, one way or the other. So, the whole thing is beginning to undermine, another phase of undermining the purchasing power of these currencies. We are beginning to see that, not so much in the dollar, because everybody's getting out of risk into the dollar. And they're principally selling the yen, the euro, sterling, and now the Chinese yuan in order to buy the dollar. It's not that the dollar is strong, it's the less bad of a pretty bad bunch. And there's some very important implications for this, because now that the trend of interest rates very definitely has turned and is going higher. And I'll give you an example. I mean, we're looking at official rates of around about sort of 2-3%, and people are talking about them going to, say, 4%. But the rate at which currency is losing its purchasing power, even today, at the consumer level, is in excess of 10%. In other words, there is not sufficient compensation for the depositors to hold on to their currency and credit with that sort of gap. So what's got to happen is that savings rates, and whether we're talking about deposit rates at the banks or whether we're talking about the yield on a government bond, those have got to rise a lot further. They've got a long way to go. If you look at the 10-year US Treasury yield, this is, in terms of investment, this is the cream of the cream. It is the least risky investment you can possibly have. And what's happened is that you can see from sort of the middle of 2020, it went from around about 0.5%. I think the bottom of it was actually 0.49%, and we're now, we've sort of, if you like, gone and topped out around about 4.3. That trend has a lot further to go. So when we look at what's now happening, at the difference between money, legal money that is, which is gold, and paper currencies, we can see that the purchasing power of these paper currencies is going to fall substantially from here. Now, there are various things that are part of this. The big problem is that in this changed interest rate environment, it is a completely different environment for the derivative markets. To give you an idea of the scale of the problem, the Bank of International Settlements reckons that the over-the-counter derivatives total a nominal value of $600 trillion. And you can add to that regulated markets, which are futures and options, which come to a further 100 trillion. So we are looking at, I mean, I think global GDP is something like 100 trillion, something like that. So we're looking at a notional value in these derivatives, which has expanded to 7 times that. That is now going to begin to contract. So what happens? Well, accidents are likely to happen on the way within the banking system. We saw recently that, in fact, it's an ongoing problem. Credit Suisse has run into trouble. Its shares collapsed, and they went down to 390 Swiss francs, 3.9 from something like 14, 15 earlier in the year. I mean, that's a very substantial fall. And they are trading at something like 25% of book value. Now, what that means is that the balance sheet shows a value for the equity, which is 4 times the current level that it's priced in the markets. So what are the markets telling us? They're telling us Credit Suisse is not worth much more than a bit of option money. Now, this is what they call a global systemically important bank. Why? Because A, it's very big, and B, it has counterparty relationships throughout the world. And if you look at the Eurozone banking system, you will see that the average balance sheet leverage for a GSIB in the Eurozone is over 20 times. I think Crédit Agricole is something like 27 times. I mean, these are huge relationships. I mean, it's just appalling. And if you look at Deutsche Bank, again, the relationship between the share price and book value is roughly, share price is about a quarter of book value. So it's similar to Credit Suisse. Credit Suisse are trying to sort themselves out. And they're putting their derivative side on, they're either closing them down or putting derivative origination departments up for sale. And this, I think, is clearly indicating where this is going. We are going to see a contraction of these derivatives. And when you get a contraction of something with a notional value of around about 700 trillion, there are going to be accidents along the way. So systemic risk is going to increasingly figure in how we view things. Now, there is another point I want to make. We're beginning to see, as you saw on that chart of M3, US M3, that bank credit is beginning to contract. It's contracting in the financial services exposure. Now, the reason for this is quite simple. Because banks, having increasingly got involved in financial services following Big Bang, enjoying a continuing fall in interest rates, which basically means that bond yields go up, which means that you can quite happily go and buy, let's say, gilts or US Treasury or JGBs, the Japanese government bonds, or whatever it might be. You could buy those in the knowledge that the trend in interest rates was still falling. So, if you bought on a bad day and you found that you're on a sort of, a short-term loss, time will sort it out. That is not happening now. We have a real problem with these rising yields. And what it means is that the banks are beginning to withdraw bank credit from financial services. Very important point. This is one reason why these derivatives are going to start contracting. We've already seen falls in the stock market. We've already seen rises in the bond yields, which basically means that the demand for them has gone. And that's going to continue. And more importantly than that, the level of financial collateral backing loans, which are not reflected on the bank's balance sheets, is the highest it has ever been in history. And I think that Irving Fisher made his name back in the 1930s, analyzing the collapse of banks in the Great Depression. What he said, and I think he wrote I think it was in Econometra, which was an economic magazine at the time. He said the problem with falling financial asset values is that it triggers further sales of financial assets. So banks are forced to liquidate collateral positions in order to remain solvent. And this is the sort of situation which we're beginning to enter into. Now, there is another aspect of this. This is going to generally move into the GDP area. Now, GDP basically is the non-financial aspect of an economy. What is GDP? Well, GDP is the sum total of transactions settled in, guess what? Bank credit. So what happens when bank credit starts contracting? GDP starts contracting. People think that a recession is like, we stop running out and buying things, or people stop, manufacturers stop making things. Not true. What it actually is a withdrawal of credit from transactions. That's actually what it is. So we can now see what the upcoming problem is likely to be, and that is, as the banks start to really withdraw credit from Main Street as opposed to Wall Street, then what are the central banks going to do? Well, the answer basically is they will probably have to step up quantitative easing again in order to replace that bank credit. What they're actually hoping for is that there's be enough time for them to introduce central bank digital currencies. And that would mean the direct relationship between the consumer, businesses and all the rest of it with the central bank, bypassing the commercial banks. But, I mean, that's not going to happen for years and years and years if it happens at all. We need an instant fix. We don't need something which, in the due course we might come up with this new system which has got to, and can you imagine with CBDCs, that's got to have legislation. And in America in particular, and we follow America, we're not going to do this if the Americans don't do it. What's going to happen is that it's going to come for enabling legislation before Congress. Now the problem then is, you look to see where Congress's interests lie. Every congressman, every senator is backed by banks when it comes to his election expenses. Is he going to turn around and bite the hand that feeds him? No. And I think this is why the banks are actually so quiet about the CBDC rubbish. So we've got a problem. How are they going to do this? I mean, effectively, they have a choice. The central banks have a choice. Do we raise interest rates in order to protect the currency, to ensure that we protect the purchasing power of our currencies, which means that we would crash businesses, we would even crash banks, but we rescue banks one way or the other, set up a bad bank. I mean, the ways of doing that, that's not a problem. But the problem is crashing the economy itself. Are they going to do that, for which they have got no mandate? Or are they going to continue to try and support the economy and make up for the contraction of bank credit? Well, we've yet to see. My guess, and I think it's worth putting money on, is that they will try and rescue the economy, which basically means that the currencies are in for another round of collapsing purchasing power. And I'm going to return to this graph, taking the other currencies out of it. But we've got, now this clearly shows crude oil. I mean, in 1950, it was something like $2.69, $2.65 a barrel. And it remained like that pretty much through to 1971. And then look at the volatility of what's happened at the, if you like, the currency price, the dollar currency price of oil. That volatility has been massive. Yet the price in gold just goes along like that. And I mean, we've known this. I mean, I don't know, it's quite interesting to look at Diocletian's edict. I mean, we're now going back to, I think about 300 AD, something like that, when Diocletian was emperor. The denarius was collapsing in purchasing power. So he did what virtually every government has done ever since with a collapsing purchasing power of the currency. What he did was he put price caps on everything. So these prices were written in stone, and if anyone tried to sell product at a higher price, then the law came down on them and they were basically executed. I mean, there was no mucking around with this. What happened was that, of course, there was no product for sale because, you're not going to sell things at a loss, you just close up shop. So cities like Rome basically emptied, because people went into the countryside in order to forage, in order to survive. That was the consequence of it. We're actually doing something like that now with energy. I mean, we can see this. So, what happened, sort of 1800 years ago, still happening today, And it always happens. I mean, it happened in Zimbabwe, it happens in Venezuela. I mean, any time you get a collapse in the purchasing power of a currency, then that is what governments do. But the interesting thing is that if you look at the price of things in gold at the time, then going all the way back to the time of Diocletian, the prices of things like foodstuffs, clothing, and so on have actually not changed that much. It's really quite fascinating, over all that time. Now, the message we get from this is that as soon as you untie currency and credit from real money, then you're going to collapse the purchasing power of that money and credit. Thank you very much.